someone whose knowledge of our industry is perhaps only outdone by his unwavering passion for the delivery of value by the best to his clients. Along with his firm DNB, where their support of shipping, support of the best practices for the environment, our people, and a determined commitment to the alignment of stakeholder interests, his firsthand knowledge helped us shape the sessions on ESG investing from both the perspective of the investor and some of our industry's best active practitioners who will follow. He and his colleagues at DNB, in the conviction that what we understand well and proactively work fiercely for, will deliver the value and the positive future we're all seeking. Please welcome DNB's Markets Managing Director, Jim Cerenza. And thank you for taking the time and making the effort to assist us, Jim, and all of your panelists. And as you all kind of come up on the screen, let me remind our viewers out there that if you want to ask a question at the conclusion of Jim's panel, there is a chat button on the right-hand side of your screen, which you can send a question in, and we will feed them to Jim. Jim, thank you very much, and thank you all to the panelists as well. I look forward to the session.
Thank you. So the panel we've put together, we believe understands the investment community really well, and from a pan-European and a U.S. perspective at a minimum. First, I want to introduce Nina Ahlstrom, who works for DNB, runs the Sustainable Finance Group, has been involved in our green bond expansion and our sustainable loan and bond business. And before that, she was in high yield sales at DNB in the Nordic region. And she's here because I believe she understands the Nordic investor as well as anyone. And I'm going to skip around a little bit. Ravi Verghese has been involved in shipping in a strange way since 2008. He was at a hedge fund back then, and 2008 and 2009 was probably the end of the greatest cycle that we'll ever see from an investment perspective in the shipping sectors. And so he enjoyed that. He went on to get a couple of master's degrees. Someone in this industry actually talked him out of getting a master's in shipping, but he does have a master's in sustainable finance. And he is an ESG analyst at Epoch in New York that manages over $30 billion. And then I want to introduce Pat Welsh, who we briefly overlapped at Goldman Sachs 20-something years ago, but Pat had a long career at Goldman Sachs in risk management. And for most of this decade, he's been with Kroll Bond Rating Agency with a high degree of focus on the ESG factors. And then I want to introduce Joachim Nakim, who after a long career at the United Nations, 4 years ago founded the Governance Group. And before I say anything more about the Governance Group, Joachim, why don't you tell us about the Governance Group and why shipping matters to the Governance Group?
Sure.
Thank you.
Thank you, Jim, and good to be with all of you today. To use Erica's terminology here, what we're trying to do at the Governance Group is help lend a little bit discipline to this ESG landscape, which I think, even to those who've worked in the space for some time and to those who are new, it can be messy and unruly, and it's not easy, to be honest, to navigate in this ESG landscape. So what
Nina.
help companies and investors do is make sense of it. That is, help find and how they matter to companies, and what you do with that in terms of engaging with stakeholders, in terms of finding risks and opportunities, and also somehow connecting this to a standard, because this is something we'll probably discuss more in today's panel, is that ESG is not standardized in the same way that financial information or financial parameters are. So it leaves a lot of leeway, if you like, and it leaves a lot of the onus on actors to get this right. So what we try to do is help investors and companies do this. In the shipping space, this has been very important to us because we've advised a number of shipping companies, both listed on the Oslo Stock Exchange, the New York Stock Exchange, on how to identify material issues and how to report on this in line with expectations from the market. And by our own calculation, we have now accounted for emissions and other ESG parameters for about 2% of gross global tonnage. So still more work to be done, but it's still a significant amount of work we've done for companies trying to bring some discipline on ESG to the shipping industry and disclosures in particular.
Thank you. Nina, you've been involved in the brief history of shipping and ESG. And one of the early on cases was the TK shuttle tanker green bond. Could you take us through that case and also the importance of the various players like Cicero in that process?
Certainly, and I think this was a very interesting case for many reasons. Still one of the most interesting ones I think we've worked on in the green space in general. And we all knew sort of ahead of that transaction that this is going to be a transaction that will create attention in the markets, most likely both positive and negative, because it's of course very easy to ask, how can a company that is transporting oil be considered green? That's sort of the obvious question and something we knew that we needed to address, and obviously something that was very important also in the Cicero evaluation. I don't know if everyone's familiar with Cicero, but it's of course one of the largest providers of sort of green certifications or second opinions for green bonds, and they have a methodology of rating green bonds as either light, medium or dark green. And I think this was sort of the perfect example of when the light green label has a significant value, because of course to reach the Paris Agreement, we can't only invest in assets that are already Paris aligned, we also need to invest in the transition so that there's actually more Paris aligned assets tomorrow than there is today. And this light green label, it really represents a significant emission reduction in the short term, but it's not necessarily the long-term solution. This is probably not what we will see in 2050, but it's still a very important investment to be done today. And then I would say that there were three elements that were key to Cicero to gaining the green label on this transaction. First of all, and also in reference to IMO targets and trajectories, this bond was earmarked for financing new vessels, and they could showcase a CO2 emissions that were 50% lower than comparable ships. In regards to NOx and SOx emissions, it was more than 90% reduction, which was of course very important, and in relation to the 50% target for IMO in 2050, these particular vessels then are reaching that already now in 2020. Secondly, which was potentially even more important, was that this was not about adding vessels to the fleet. This was about replacing older vessels. So it's not about increasing capacity, it's about making current capacity more energy efficient. Because as long as oil and gas is in the energy mix, which it will be for quite some time, we need to do what we can to reduce both direct and indirect emissions from that sectors. And thirdly, sort of looking more technically on what these vessels were actually about. They were introducing perhaps not always new technology, but technology that has not fully been seen as commercially viable from a shipping perspective. So in that sense, Cicero also placed quite a lot of emphasis on the fact that the company showcasing that this is commercially viable for them, hopefully can also accelerate decarbonization in the broader shipping industry and not just looking at sort of the oil tanker space. So that was very, very relevant. I would say from an investor perspective, there were obviously varying views. I think this, given the large share of the company's turnover coming from oil-related businesses, many of the greenest investors might not have been able to invest because they have exclusionary criteria for this particular sector. But for many of the company's existing investors, it was very important to see that this company is willing to be part of the transition. They are making significant investments to move in the right direction. And they were transparent enough to do it, to qualify for the green label. So a very, very interesting transaction, I believe.
Thank you. Pat, KBRA, can you tell us about your approach? Can you tell us about your credit department and the work you do?
Sure, Jim. Maybe let me give 20 seconds on who KBRA is. We're a full-service credit rating agency. We were founded on the belief that credit ratings could be a little bit better, frankly, better in terms of transparency, responsiveness, timely analysis, research, etc. So we were founded 10 years ago by Jules Kroll and Jim Nadler. We have now nearly 40,000 ratings, over 2,600 issuers. We've got 400 plus employees. We cover 15 different sectors, including, of course, transportation and the shipping sector, where we have a number of ratings. And we rank first or second in a number of sectors in terms of number of ratings issued. I guess I'll just give a brief summary because I know that we'll get into it in a little more detail. But KBRA is a purely focused credit rating agency. So we do not now, nor do we have plans to be in the ESG ratings business. So we just produce credit ratings, and we aim to produce the best, most rigorous credit ratings in the world. And so in that vein, ESG fits into our world only in as much as the ESG factors impact our credit analysis. And when they do, then we're very transparent about what those factors are and how they impacted the outcome of the credit rating. So that's a little bit different from some of our competitors. And of course, it's different from other ESG rating firms, which those ratings take into account lots of other things beyond credit risk, or frankly, even beyond financial analysis. So I'll pause there.
And I'll give you another 30 seconds just to talk about the general landscape as it relates to the rating agency business.
Sure. So you have kind of the spectrum. You have, on the one side, you have KBRA, which is purely focused on credit ratings and the ESG factors that are credit risk factors and otherwise, not involved with ESG ratings. On the other end of the spectrum, you have some of the rating agencies that have credit rating agencies that also offer ESG ratings, and then you have some that are a little bit in between that are trying to, within their credit ratings, speak to ESG factors, even if those factors did not impact their credit rating. So there's kind of a full spectrum, I'd say, between pure credit risk analysis and credit risk analysis coupled with ESG analysis.
Thank you. Ravi, you're an ESG analyst at a big fund that doesn't have an ESG fund. How do you incorporate ESG analysis into the investment process at Epoch?
Sure, yeah, and thanks for having us. So again, just to give a little bit of background on Epoch, we manage just under $30 billion through several different products. But again, traditionally the focus of Epoch has been analyzing the free cash flow prospects of companies and really paying a lot of attention to how that free cash flow is allocated. So in some ways, some components of ESG have always been part of the firm's approach, but the firm has really made an effort to make that more explicit over the past few years. And this is a process that really started in late 2017 under the leadership of our head of ESG, Richard Watt, who started the process of trying to understand what an ESG approach might look like for a firm like ours. And I think, Erica mentioned this in her keynote earlier, there is no such thing as ESG investing as a monolith. You know, it really is a very diverse field. And so the approach at Epoch has been really to try and find an ESG approach that aligns with our more traditional investing processes. And so, you know, what that has really meant for us so far has focusing especially on climate change as an ESG issue. And we do that, you know, by both thinking about physical risk of climate change, but also, you know, as carefully as we can about the transition risk of companies in our portfolios. So, you know, we don't exclude any sectors. We don't exclude high carbon sectors necessarily. But I think analyzing the transition risk of companies in our portfolio, various portfolios really, has a lot to do with, first of all, identifying which companies those are that are, you know, exposed to carbon transition, doing, you know, extensive research trying to understand those companies' strategies for how they may, you know, hopefully survive and thrive in a low carbon world. And then sort of testing that by speaking to companies, engaging with companies, really, you know, trying to understand their strategies better and, you know, using our voice as shareholders to express our views. And finally, you know, I'd say the last piece of that is using the proxy voting process, you know, as a further expression of our views and another avenue through which to influence companies.
I'm going to stay with you for one more question to focus on your transparency with your investors. How do you communicate your ESG efforts to your end clients?
Yeah, it's been a process and one that we continue to make progress on, frankly. You know, given that this has been very much a work in progress, you know, this approach that I just spoke about was honestly, you know, designed partially, you know, through speaking with clients and trying to understand what was important to clients and what really resonated with clients. So I think that was sort of the first step. You know, we've certainly improved our ability to convey this process to clients. And you know, last year, for example, we released our inaugural ESG investing report at the firm, which is available on our firm's website for anyone who's interested. But you know, also reporting through mechanisms like the PRI, for example. You know, it's a fairly labor-intensive process, one that I think, you know, adds a lot of credibility to our approach and really provides transparency to clients. But again, you know, as I said, this is really an evolving process, and you know, what we've noticed is that initially, I think the largest impetus came from clients in Europe and probably Australia. And I think we're finding that, you know, our US clients are becoming every bit as sophisticated and interested in this topic. So I think that the push for transparency is only going to increase. And we're frankly seeing that, you know, already just in terms of the kinds of questions and the sophistication of questions has really increased over the past year.
And thank you. And Nina, I want to stay on this topic a little bit. So I'll give you the broad question first, and then I'll push to be specific. But along that vein, how do Nordic investors think, and how do they invest? What kind of transparency are they providing to their end clients? And what do they expect from the companies they invest in? I know that's a big topic, but you only have a couple minutes.
I'll try to be as brief as possible, but I'm definitely certain that sort of Nordic investors and potentially predominantly Swedish investors have been very active and very vocal for quite some time when it comes to their integration of ESG factors into their investment strategies and mandates, and their expectations on companies have definitely increase. And I think it's been quite a few years ago now since we started hearing that, no, unfortunately, I can't invest in this or that company because I'm full on CO2 in my portfolio. And then that sort of goes from sort of a nice to have feature reporting on CO2 to actually having a fixed ceiling, that you can't go above that, which obviously puts some pressure on the type of investments that you can actually make and the priorities you choose to make. But I think a lot of the things that Ravi mentioned, that Erica also mentioned when it comes to transparency, certainly very, very relevant. Investors want to see that the companies they support have a clear strategy, and not only having a strategy, but having clear targets, and also what are you actually doing to achieve those targets. And this transparency, of course, is relevant because the investors themselves need to report that to their investors. And the requirements also when it comes to, well, from a regulatory perspective, if we look at what the EU is currently doing with their action plan on sustainable finance, an upcoming taxonomy to define green assets and sort of increasing reporting requirements, I believe the request for transparency will just continue to rise, probably or hopefully in a more standardized way, but it's definitely something that's becoming more and more important. And I just one final comment, sort of when talking about ESG and the E and the S and the G, I sometimes feel that sort of the S and the G are often sort of prerequisites. They're almost seen as a hygiene factor for many investors, but what really can make a difference is what you do within the E. What's your impact when it comes to the environment? What are you doing to reduce it? And of course, how are you impacted by climate change or climate risks? Hopefully that answered at least some of those questions.
Yeah, we're going to keep the Nordic hat on for a moment here. Joachim, your ESG 100, and I even Googled it this morning, your ESG 100, talk about how you score the companies and obviously what you do as it relates to the Oslo Stock Exchange with this.
Yeah, so we launched earlier this month the ESG 100 Oslo Stock Exchange report, and that's the third year running that we've launched this. And essentially what we do is we rank companies based on all the factors that Nina, Ravi, and to a certain degree Pat mentioned about how transparent are they when it comes to disclosures. So what we look at are key parameters under E, S, and G. And we say, if we look at your public reporting or your publicly disclosed information, can we find the key factors and the key disclosures that the market is expecting on ESG? So importantly, we do not rank the companies based on how sustainable they are or their industry. Surprisingly to many, certain oil companies or perhaps brown companies will show up high on our ranking because they're actually quite transparent. They say, these are our emissions. This is how climate risk impacts us, to use Ravi's point here about using the TCFD framework. We can find the information. We can find the information is in line with a framework such as SASB or GRI or CDP. And for the first time this year, what we also looked at is ESG opportunity. Does the company say anything about the transition in terms of where does it see business opportunities? Is it going to be able to make money in the transition? I think this is a key element on ESG, moving from risk to opportunity. The hygiene factors that were mentioned, that is getting your house in order. We expect companies to have that. But can you actually show that you have a business case in the green transition? Even if you're not in renewables, there are tons of opportunities out there. You know, we're working with a drilling company that is looking at carbon storage and carbon capture. So I think for every industry now, there are opportunities there. And the market is really looking for how you're managing these opportunities. And I think that is really key here is focusing on ESG as risk, but also as opportunity. So our ESG 100 report essentially is, rather than you having to go into all the reporting of every company, you can look at our report and say who actually provides in a transparent manner and in a way that markets want to see this ESG information. So we work a lot with the companies to discipline them to be able to produce that information, which then again is something that we look at in terms of transparency. Just maybe one final point, Jim, we're looking at doing this ESG 100 report actually for the shipping industry. So globally, we're considering doing an index of a group of shipping companies globally represented to see, do we find this information among the shipping companies? And to be honest, we think it's actually doing the companies a favor because we're helping them prepare.
Yo, team. I've got an 18-year-old daughter that attended a lot of virtual classes this last 6 months, and she's an actress, by the way. And so what she does when she gets a question that she doesn't want to answer, she pretends to be frozen like this. So, but I'm guessing.
Good tip.
Okay. All right, when Joachim's unfrozen, we'll get him back to finish that. But Pat, let's talk about the flaws in ESG ratings. Bring in the MIT study.
Yeah.
And I'm going to give you a really long question, but you only have a couple minutes. And then let's talk about the history of sort of E, S, and G.
Sure. So yeah, I'm fascinated by this conversation because it's interesting. Nina said something that I've heard many times, which is S and G don't really matter if we don't have a livable planet, right? So E kind of overrides. That's sort of, you didn't say that exactly, but sort of along those lines. And then Erica basically said, which is also interesting and kind of true, that everything emanates from G because everything is kind of is a governance decision about S and E and S. So it just highlights, I think, the big problem, in my opinion, going on in the ESG world, investing world. And I think Erica is right. It's all about analytics. It probably needs to be less and less about ratings. ESG is just far too big, in my opinion. Each one of those categories is far too big to put a rating on it. And there's also lots of subjectivity that would have to go into producing a rating. Now, I don't mean to take pot shots at people doing those ratings. I really don't. But I think the world needs to be aware of the deficiencies in trying to rate something so big and so complex and distill it down into one rating. I mean, MIT did a study. There's several now that show that the correlation between ratings across ESG rating firms hovers around 50%. And you can compare that, for example, to credit ratings, which have their own flaws, even though I'm in that business. But credit ratings across different companies have a high 90 percentile correlation. And there's a reason for that, right? There is a rating scale that most people understand. If you go around the world and you say something is AA rated, they have a pretty good idea of what you're talking about. And the credit ratings are things that you can research and you can backtest and you can quantify, and they're based on normally on quantification, and they're based usually on a very similar set of data. So you compare all of that. Not that credit ratings are better; they're different than ESG ratings, but they're different in those regards. ESG ratings, I think, have a long way to go to have the kind of usefulness in the capital markets that a credit rating has. Even if you disagree with a credit rating, at least you can understand what it's trying to tell you. It's about default risk. ESG ratings are about a myriad of things. So maybe I'll pause there, Jim. I don't know if I got to all of the.
No, that was good. And let's go, Robbie again. How do you use or not use the ESG services out there, the MSCIs, the Sustainalytics, et cetera?
Well, I think we certainly use them as kind of a base layer of information, particularly because, given a relatively small ESG team, we can only do that sort of deep dive research on a select group of companies. So, our current process means that, whenever a name comes into the portfolio, an analyst needs to do a write-up on that name. And they will tend to lean fairly heavily on the research from some of these ESG firms that Pat has mentioned, although perhaps not necessarily the rating itself. I think where we have the opportunity to dig deeper into these companies our view becomes more nuanced, and we're certainly more comfortable than veering away from what the rating is. But again, we think the information in these reports is helpful and probably more useful than the rating themselves. But I will say, for active investors like ourselves, the dispersion in these ESG ratings may actually be a helpful thing. I think Pat's right. It's not necessarily quite akin to credit ratings. It may be more like a sell-side recommendation on equities, where you tend to see greater dispersion among opinions, and it really sort of depends on what the underlying investor is looking for. So I think they do differ from credit ratings in that respect. And so I don't think we are necessarily going to focus on ESG ratings per se that much. We do use other ESG data, such as carbon analytics, for example, in our work, and that is to identify some of the larger contributors to our firms or our portfolios' carbon footprints, and B, to sort of get a better sense of how those companies are poised to, again, thrive or survive in a lower carbon transition world.
All right, we're running low on time, but there are two more questions I want to ask. So first of all, Nina, as it relates to sustainable bonds and sustainable loans, talk about how that market is developing. We even have one of the shipping companies presenting tomorrow that we've had some recent experience with.
Good. Yes. I mean, I would say that the demand is ever increasing, and every year, if we look at both sustainable bonds and sustainable loans, it's a new record year every year. Although I think 2019 was certainly exceptional. I think we saw sort of 84 or 85% growth in volume compared to 2018. And even if the beginning of the first few months of this pandemic was sort of slower, this is picking up, and I would expect that this year again will surpass last year. And we definitely see a lot of interest when it comes to sustainability linked loans, which if you compare with sort of green products or green bonds, we mentioned the TK deal, this is not about earmarking money. Instead, you link the actual cost, the margin on the loan, to some form of sustainability metric, quite often emission reduction. We've seen a couple of examples in shipping already, for example, international seaways or in LPG. I'm expecting more to come. It's definitely a very interesting product because it's very nicely ties together with the overall strategy of the company, and not only sort of a portion of its business. So a very relevant complement to the green market, and this is something we are starting to see also in the bond market. The bond market has been very focused on the green bonds, but the sustainability linked feature is now starting also to pop up on that side, which I think is very relevant. And of course, green bonds have their benefits of adding transparency around where the money in the end is going. But then in contrast, sustainability linked loans and bonds may have sort of a closer tie to the overall strategy. So far, looking at a global basis, bond markets, it's roughly above 1% of volumes that have been issued as sustainable or one or other form, which is obviously not a very large share, but there are large regional differences. And if we look at going back to the topic of an active Nordic region, if we look at everything that was issued in the bond market last year in Swedish krona, almost 25% had a sustainability label, mostly green, a few social as well. And then that's quite a big and remarkable share of the market, definitely a sign of the demand for increasing transparency.
Thank you. And Joachim, now that you're back, I'll give you the last question. What advice would you give a shipping company, in a world where we all have stakeholders?
Yeah.
What specific advice would you give?
Three quick pieces of advice. The first one is exactly with your stakeholders, help identify what the material risks are and opportunities. It sounds easy, but it does actually require some engagement on your side to reach out to stakeholders, put their risks and concerns into a standard. The second thing is to disclose information according, again, to a standard. So it's not self-defined, so you get your emissions data correct, you get your S&G disclosures in accordance to a standard. And thirdly was my point about opportunity. I think there are a lot of opportunities out there, and this comes back to the innovation point by Erica. Start identifying these opportunities because they actually do have financial materiality. You're not just doing this as CSR or to be nice, and I think this is the big transition from the classical way companies, shipping or otherwise, have been working around ESG, still a little bit stuck in corporate social responsibility or altruism. This is about what is actually financially material to the company and getting your ESG house in order, if you like. And then my very final point is I think shipping has a comparative advantage to some industries when it comes to ESG here, and that is discipline, actually. You know, shipping companies are very good and used to technical data, classification, getting management systems for dealing with all these numbers and technical requirements. If they apply that same discipline to ESG, it's going to do really well as an industry.
Thank you. And I just got a signal on my screen that we used up our time unless John decides that he wants to open it up to the audience.
Yes, I think that we got quite a few questions come in from the audience, and so we're only going to be able to do 2 at max, which I apologize to the audience, but hopefully we'll be able to get something in the next session. So the first one is, you know, Erica said companies and investors need to, you know, pick the ESG goals that are important to them. It seems that disclosure is key. What is the status of disclosure among companies? What do they disclose and to whom? We're going to use Jeopardy rules. Whoever feels like they want to like take the baton on that one first should just speak up immediately.
All right, since nobody else is doing, I'm not sure if that's the $500, $1,000 category or question under Jeopardy, but I think, you know, the status on disclosure is partly already assessed by third-party rating agencies. So Sustainalytics and all these, if you want to get a good rating, you first have to make this information available. They use mainly publicly available information from your policies, governing documents, and disclosures reporting as a basis. So to do well there, you need to disclose this. And I think that's a pretty mixed bag. A lot of the poor ratings that companies have is not because they're actually not performing well, they're not disclosing well enough. So when we started working with the Fredrickson companies in shipping and Eagle Bulk and others, they actually had a lot of this information available. They were just not publicly disclosing it, and that gives you a bad score. So I think that's a fundamental shift in the thinking of companies' areas. You need to share this. You need to be transparent, and you will get a better score.
Okay, great. Does anybody else want to jump in on that, or
yeah, I'd like to just echo that last comment, please, which is that, you know, we've seen at KBRA a few sectors that suffer the same problem, and part of the issue is they receive the same surveys or the same kind of request for information, regardless of their size, regardless of some of the attributes of their sector. And what happens is they oftentimes put NA in the answer, and it produces a bad rating outcome, which is not accurate and not appropriate.
Great, great. There's a second question that came in. Have any of the speakers looked at ship recycling as part of their ESG criteria when evaluating shipping companies?
I can add just from our banking perspective that the recycling as part of the responsible ship recycling standards, this is something that we integrate in our loan requirement or loan documentation. So it's actually sort of a requirement when it comes to getting a loan from our perspective. And this, I don't know exactly how many banks, I must admit now, that are part of this initiative, but I think that is one very sort of efficient way of actually getting action in the markets.
So if I may just jump in briefly, we had a client who had exactly received some comments from DNB on ship recycling and wanted to know what their approach was, because a few ships they owned had showed up being scrapped in what was found to be yards that were caused concern. And there are public records in terms of where these ships end up in Pakistan or Bangladesh. And not all the yards are bad, but the point there was, again, what is expected, and we place this under the G, not E, because it's about governance. It's about the management approach to ship recycling. Do you have a policy? Do you have guidelines? How do you do this? Under what circumstances? How do you write contracts with cash buyers? What yards do you use? Is there a third-party verification, etc.? So for us, ship recycling is very much a G question, and we think we're going to see an increase in recycling or scrapping, and therefore it's really important to have a management approach there. So this is something we really urge companies, even if you're not scrapping right now, have a management approach in case DNB or a credit rate or a rating agency asks you about this. It's important to have it publicly available. That's our approach.
Fantastic. I think we have time for one more question that came in. Will the ability to raise sustainable capital be a competitive advantage going forward?
If I can jump in again, I certainly think so. And I think in one way, it will almost be a prerequisite in one sense to really show how you are working with sustainability, with ESG, what your targets are for the future. And you may very well be able to access capital anyway, but it might be at a higher cost. So I think this is definitely about access to capital in the end.
I might just add to that. I do think that there is currently a role for capital that is earmarked, specifically as sustainable. But I think, coming back to sort of what Joachim was saying in terms of ESG opportunities, I think increasingly, the industry is going to look at some of these issues as just being sort of, part and parcel of, normal financial analysis, really. And so I think that, companies don't necessarily want to just take capital from capital providers that, have a certain financial sustainability mandate. I think they will want to take capital from the most engaged and most sophisticated capital providers possible. I think, that's how you sort of mainstream this. So I think there certainly is a role for, that sort of niche sustainable capital, but I think increasingly if this is going to work, these have to be integrated in a far more sophisticated way.
All right, so that wraps up the Q&A piece for this first panel, and I'll hand it back to Jim Lawrence to wrap up this before we go into the break.
Great. Well, it really is just my pleasure and honor to say thank you to Jim, Nina, Pat, Ravi, and Joachim for participating. As a listener and someone who's hopeful about the future, I feel like we're in good hands with each of you. And Joachim, thank you for showing us that even technical challenges can be overcome. I appreciate it. We're going to take a 5-minute break. This is for the people outside. That we're going to take a 5-minute break, and following which we're going to return for Jim Sorenza is going to lead us through a discussion with best-in-class shipping CEOs to get their take on what we've just heard from the world of money and investing. And once again, thank you to all of you for taking the time to prepare, practice, and go through the training and technical stuff. And good luck in each of your businesses. So we'll take a 5-minute break. Everyone, you'll see the rolling deck of pictures, which only makes me want to cry because I wish we were all together. But enjoy them, and we'll see you in 5 minutes.